Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter. We're going to go over some information. Also, I'm going to answer some questions that people had on Twitter. They wanted me to go over it. And again, I'll give you my financial opinion. I'm of a different viewpoint than, I guess, the majority of people. And guys, I'm not going back over to that herd. I'm not being dragged over back into the herd because I don't like being in the herd. I don't thrive there. And I'll tell you what I mean by that. So let's just dive into it. We can get into it. And let me pull up my TradingView account real quick as well, because I think I'm going to have to need that. So if you want to follow me, you can follow me at finding_finance. Add me on there. I do post a lot of things. So here's something I want to talk about as well. So platinum breakout is so close. This will mark the beginning of a new bull market for platinum. So that's what this person's saying. You know, could be a new bull market after we get this breakout. We're up 3.5%, 4% or whatever it is today. Let me say something here. So we look at platinum. It's up 3 point something percent. When I view this, guys, this is already broken out. This is, here's logarithmic here. That's when I drew it on logarithmic. This already broke out. It broke out here. It already broke out. And I think it broke out again already. It's already gone. And I know people are shading in kind of this, down pattern. But how did I play this? How did I maximize the most amount of money out of this? I actually started buying it in 2019 down here. Okay, maybe it was over here. 2019 over here. So I started buying it here. We came on up, and then we had a huge sell-off. I bought a bunch down here. I bought a bunch in here. I bought a bunch in there, all coming on up. And then I bought a bunch in here. And if you've been part of the website, you know I've been buying it quite aggressively in this area. I bought it all through that entire area. Why did I do that? Why did I not wait for a breakout and buy it up here where people think that this is less risky, even though I'm sitting on some of this money, 40, 50, 60, 70% gains, depending on where I bought it. Why did I do that? Because of the ratio of platinum to gold, platinum to silver, platinum to palladium, and platinum to rhodium. All of those ratios signaled that platinum was off the scale cheap in this entire area. So I prioritized the ratio over waiting for some breakout. And that's just me. You don't have to be me. Another thing I did, this here is a consolidation period, and we were basically grinding off the cost curve, which is in this area. That's the cost curve. It's bouncing off the cost curve. So if you know commodities and you know where the cost curves are at, all these commodities bounce off the cost curve. They all do that. So if someone says in a scenario where you're coming into an expansionary phase of real estate, which has historically been inflationary, platinum does well under inflationary conditions. Platinum is the cheapest it's ever been against gold, silver, rhodium, and palladium. You've got a setup where you've got a 1, 2, 3 hump pullback. You've got a capitulation bottom, and you've got a wedge formation forming right before a historic commodity bull market. You've got commodities priced against stocks, the cheapest they've ever been in 100 years. Why would I not buy it based off of where it is in relationship to the cost curve and in relationship to the other metals, which are all cheap? And I've got mounting evidence. The confluence of evidence of a commodity bull market forming is everywhere in the markets, in all the charts. What gets you the bottom isn't luck. What gets you the bottom is knowing the technical analysis, knowing the ratios, and knowing the market conditions of how to buy the bottom. Now, was this bottom an easy ride? No, it wasn't. Because I bought it here, and I would have, all the fear in the market, I bought a massive amount in this bottom here. Then I'm buying again over here. How did I know how to do that? I know the cost curves of platinum, and I know how cheap it is with the ratios, and I know that the market conditions were changing for a commodity bull market based off the expansionary phase of real estate. That's all the thesis that I had generated. Now, I've got a lot of people. They're saying, Andy, we've got a crash coming. I should sell out of my positions. I don't agree at all with that position. I am accumulating for the bull market that's coming for the next 10, 20 years, however long it is. Why would I be jacking around, buying and selling and trying to time the short-term movements? I'm sorry, that is not my game. And I know somebody wants to come on the channel. They say I should debate them. I don't know what to debate. That's my strategy. That's the thesis that I created in my strategy. My strategy is to accumulate when things are cheap, aka in this general vicinity down here in that block, and then ride it higher for the bull market. I did the same thing in silver, and I've been holding silver for years. I started accumulating silver in 2018. 2018, I'm sorry, I started accumulating silver before that. But when I started to reaccumulate it, it was in 2018 in this block over here. I bought a whole bunch in 2018, a whole bunch. I was buying American Eagles for $1.99 over spot when they went on sale. And it was like $14 or $15 spot price at $1.99. I was getting it for like $17, $18 for the majority of my purchases. And I bought a lot. And look where we are today, $24 and increasing. And I tried buying it here, but the premiums went gigantic in 2020. It was actually not as good of a buy as it was in 2018 because of the premium differences. I did get a couple of monster boxes down here when they didn't lower it was crashing at the time, and they had it on eBay. I bought a couple. It was $8,600 if I can remember. But now the premiums have gone up and I'm just holding. How am I doing this? Because I know where the cost curves are at. The cost curves are right there. I'm buying the cost curves. I'm buying the ratios. I'm buying all of this stuff. And then I'm linking that with a time frame of a decade plus. I'm not playing the short term, guys. I'm not playing the little movements in the market. I think that's literally, there's no money to be made there. I'm playing the big move. I'm playing it like the billionaires play it. That's where I've learned. I've learned all of my kind of history is based off of reading Peter Lynch, Buffett, watching what, Eric Sprott's doing. He's not trading in and out. He's buying this stuff and piling in when things are working. Now, this is kind of the base of my portfolio, is these physical metals. It's the anchor of my portfolio. The anchor is what's going to how can I say this? I'm taking the least risk way, and if I get a double out of platinum and a double out of silver, just a double, I double my entire net worth almost based off of how I'm weighting this. Everything else is just cream on the top, guys. It's just cream on the top. And then I'm using patience and time if I have a bad entry point, and then I continue to cost average in. And then I know a lot of people will say, how do you know that cost averaging is going to work? Because the ratios and the historical movements, the inventory balances, supply demand balances, I am looking at all of that. And I have what I think is the opportunity in a commodity bull market, given the market conditions, breaking interest rates to the upside of a 40-year downtrend, all of those things. So let's dive in here for some more action here. And I want to make sure you guys understand how I'm operating. So someone wanted me to comment on this. It says, all I see are lumber and gold. Why? Nearly every major crash, correction, and bear market has historically been preceded by weakness in lumber relative to gold. So you know what they're comparing here on this? They're comparing basically the weakness in new home builds. It's housing starts. Lumber, aka housing starts. When housing starts go down, the demand for lumber goes down. Now and when a crash starts to come, gold does very well before the crash and after the crash. It outperforms relatively to lumber. So he's looking at the two relative the assets and the relative strength between those two assets and how it moves against each other. And what that does is it gives you a glimpse into the market conditions. Those two trading against each other sets up a potential for a crash. So he's measuring the market conditions. It doesn't mean that it's 100% likely going to be a crash. It's just saying that we have an elevated risk of a crash. It's a pretty smart way to do it. Now, here's the thing, though. Let's pull up lumber real quick. And this is where it gets a little bit interesting. So if we pull up lumber, and I watch lumber too, here's lumber. So here's the difficult, let me get off log here. Let me go all. So we're taking a big picture view on lumber for this movement. Now, when you've got lumber here, this is lumber, and I'm just going to draw something on it. When you've got a steady state, and this is, let's say this is lumber production, and it's just lumber production's going flat, and your demand goes and exceeds the supply of lumber, the lumber production here, right? Your demand's over, and then the price starts. This is demand. This is supply of lumber. When it goes up, and you have a stable lumber supply, what this is saying is that, hey, look, prices are increasing of lumber because the demand is exceeding the supply, which means that we're probably building more new homes. And I don't use lumber as an indicator. I just go look at the housing starts, because the leading indicator isn't necessarily lumber. Lumber is a lagging indicator. The leading indicator is actually volume of loans. And then the ultimate leading indicator is demographics interacting with the housing market. So the housing starts is your leading indicator. So I don't even use this, but this is the way I wouldn't use it. Now, what happened in 2020? You can see that this has been pretty stable. Then all of a sudden, we popped up, we came back, and then it just went berserk. Our supply of lumber in 2020 got disrupted. And in my opinion, it's still trying to find a balance over here where we've got lumber trying to find a supply balance, and we've got demand being flung all over the place. We have two very unstable areas. Unstable from the supply side, unstable from the demand side. And I think it's hard to use this as a good gauge. What I would do is I'd bypass the whole thing and go to housing starts. So if we were to bypass that and go to housing starts, where housing starts is right here. Here's our housing starts. We're at 1.427 million housing starts. And it's still above average. We've got this uptrend line right here. This is our ratio of a buy signal, and then the housing starts going into an expansionary phase, and a commodity bull market have basically all linked up in history. So we're in this uptrend still, and there's nothing to worry about at this time. Even if we were to dive below it for a little while, as long as we stay above 1.2 million, I don't really see it as a huge problem, at least not yet. The inflation comes from the volume of home loans against new homes. That's where your majority of new credit is being created in the system. The new credit in the system, which we can see under total bank credit, is where the inflation's coming. So we see a dive down. In April of 2022, we've come on down. And if we look at total bank credit, you can see in June of 2020 that, so this is from the stimulus money though, that's the stimulus money. But we've seen a little bit of a decline here from that stimulus money, and we've been flattening out, potentially ready to go higher in total bank credit versus GDP. This here is your inflation. When this goes higher like this, you get these large commodity bull markets because you have more money in the system chasing fewer goods and services. That is inflation. And we've broken out, we've done the retest move, and now I think we're going to go higher. Total bank credit, loaning is in that. And I know that the Federal Reserve wants to slow this down immediately because that's where some of the credit in the system's coming from. So that's my opinion, is I don't know how well lumber and gold are going to do if you disrupt the supply chain of lumber in 2020 with the shutdowns, and now we've got interest rates going all over. It's flinging things all over the place. We also have stimulus money in the system. This stimulus money is also, this money here is also throwing false signals, I think, in the markets. And I went over that in another clip. So that's what makes it difficult. And I don't know if these signals are necessarily legit, because if the interest rates chase the stimulus inflation higher, it shut off the housing market. But in a stable market where lumber, every single time in history, the housing market's been the pacing factor of inflation. This time, it's not the pacing factor. It's been inflation from the stimulus money, which shut down the housing market because the interest rates chased the inflation higher and went to a rate where the housing market is not sustainable, in my opinion. This signal is great under the old regime where the stimulus money wasn't in the system. And the reason it was great is because when lumber declines, that is your portion of the beginning of a crash where there's a deleveraging and less money being loaned into the system. But I don't know if that's necessarily true, because the stimulus money created the inflation, not the housing market. If the housing market didn't create the inflation, then you do not have the deleveraging from the housing market in the system. That risk is gone. So we may not get a blowout crash. We can still get a recession. We can still have this overhang in the market where I call it the hangover from the stimulus money, where we do get a slowdown, but it won't be a blowout crash like 2008. It won't be a blowout crash like the Great Depression, because we don't have the deleveraging in the system. Here's another one. It says, if you're an oil bull, you don't really want them to have to cut a lot of production. Well, they aren't cutting production, guys. They are increasing production. They are just cutting their quotas. This market is super tight in terms of oil. And when the SPR releases are done here in December, we're going to see how tight it is. And everyone's looking at the commercial inventories. We consumed hundreds of millions of barrels out of strategic petroleum reserves worldwide to hold those commercial inventories higher. What's coming is going to be a complete destruction of the commercial inventory levels. So what am I doing? I'm going long in oil, massively long in oil and energy service companies. Why? Because Powell's trying to basically destroy the demand before this supply crunch happens. And I don't think he can stop it. That's what I think. So coming on down, we've got still releasing that SPR. They released 3.5 million barrels, but guess what? We still ate through inventory, minus 1.3 million. Imagine if we had a minus 4.8 million inventory draw, and every single week we're eating through inventories at that clip. Oil prices are too low, guys. They're too low, and we're going to start eating through all the inventory soon. It says, if you're bearish gold, which I am, major lows have come when price and cost meet, and they've done this repeatedly. So what this is he's basically saying that the price of gold's just going to bounce off the cost curve. And that's where I buy. I buy it at the cost curve and below. It says, and this is exactly why my target is cost of production, which I see currently at 14xx an ounce. So this is the gold price. This is posted by SRS Rocco Report. Here's your cost curve. Your cost is where that is, and their cost curve's at like 1500 or 1447. Could this pull back to that cost curve? Yes, it could. It very well could. It says, for 50 years, the price of gold has been extremely volatile due to an increase in speculation. The red bars costs represent the estimated cost of production. Thus, the gold price always bounces off these levels. And that's where I was buying the cost curves, where was off the cost curves of a lot of these things. Now, right now, this could come back. It could pull back and go off the cost curve at $1,445 or $1,500. That is a complete possibility. And I think the cost curves are going to continue to increase over time. And it's going to be a driver of that is going to be fuel costs. Here's the report for Barrick and Newmont total cost of production. In Q3 2022, Barrick and Newmont's total cost was $1,561 versus the gold market price of $1,728. Amazing how rising energy prices impact the cost of production. And I've talked about this quite a bit in previous videos, where the cost of production is going to continually increase and the gold price will increase alongside of it. The question is, are the mining companies with increasing production costs going to actually make more money? Or is their margins going to remain relatively stable over time? This sounds to me like the royalty companies are going to do quite well because the price of gold's going to go up, and all they do is collect a royalty off of it. Now here, I wanted to talk about this one too. It says how to get promoted in 2023. It says, keep up with the industry news, try out new software, read, track your time, listen to podcasts, use time blocks, get 7 to 9 hours of sleep, network with your coworkers, be likable, do the work, and finally ask for it. And I think that's fine. But there's something I want to talk about here. And find something you're really interested in. All right? Because when you start to go into this, and let's say you want to get promoted at work or something like that, and you're at work, you're doing all of this, what it's going to do is it's going to consume your life. And here's another thing. There was things like when I was building a car, one of my cars had a problem. The boost was not working on when I first purchased a car, and I was going to fix it. And what I did is I focused all my energy on fixing it. So I said, okay, it's not working. It's a 2-turbo system. One of the turbos was working. The second one wasn't. And I was like, well, it's all connected, right? So everything was connected, right? It was one valve that was not working properly, even though it functioned when I blew into it. Like put it under pressure, under vacuum, I should say. So what I did is I tied it open, and then the turbo kicked on. It was obviously a bunch of lag, but it worked. So I knew that valve was bad. But I was thinking about it all the time, trying to figure out what the heck was wrong with the system. And even when I went to bed, I was thinking about it. And I actually solved that when I was asleep. So when you find a job and you're trying to do this and you're spending all your time and efforts doing it, one thing I think you should think about is how much effort and how much time are you deploying into getting this promotion, and what's the promotion payback? What's the payback over a 10-year time frame of basically putting all of your mental thought into it? I know a lot of design engineers, they go back home and they think about it all the time about how to make something better, and they're not getting paid for that time. Even though I think they should. They're thinking about it, trying to figure out a way to do it, and sometimes they solve things in their sleep. I transitioned my thoughts and my worries, I should say, not really worries, I focused my efforts on investing. That's what I've done recently. I don't even think about work anymore. And I'm sure that's to the detriment of where I work. My performance is probably going down because I'm not focusing all my brain power on how to become better at manufacturing things, even though I've been in it for a long time. I'm focusing my efforts on investing because I can get far greater returns in that area than I can working. I can make multiple millions of dollars in a year doing that. I can't make anywhere near that focusing my efforts on a job. So I'm focusing my efforts on other things outside of my, call it, daily job. It's dangerous to put all of your efforts and all your eggs into one basket that doesn't pay out very well. And now I'm to a point where I've accumulated enough where I can start really making a lot of money. So I need to focus my efforts on making that because my returns will be that much greater. So I just wanted to talk about that for a little while. It says, whoa, I've been wondering what this might look like. The U.S. mine cost inflation. And we can see a massive move of inflation. But guess what? We already know that. I've talked about it in a bunch of different clips. I've talked about it in a lot of question and answer sessions. Why the miners may or may not, it depends, because what you're playing, it becomes a lot harder. You're not playing a direct way. So when I buy physical platinum, I'm betting that the price of platinum goes up. It's that simple. Price of platinum goes up, we're all good. Now, what if we're in a gigantic energy crisis, which I think we are? What is the price of the mining cost going to do? Mining cost is going to go up. The cost curves are going to go up. It's going to force and pull all of my physical metals up and up and up and up and up based off of the fuel costs and input costs to the mining companies. I am playing the direct way of the price. Now, when you buy a mining company, you're not playing the direct way of the price of the commodity. You're playing a complicated way to profit. You're playing the margins of the producer. So you're playing the input costs versus the price of the metal. And it's a lot harder to do that, in my opinion. Now, I've got a bunch of diversified mining companies across the thing, and I do think that there are going to be shortages of metals that are going to get fat margins at some point. Totally agree there. But some of this is not as clear cut and as easy as what people think. And maybe it is. Maybe the price of the metal is going to far outpace the price of fuel and other inputs, where it's going to make a ton of money. And I do own some mining companies because of that reason. But just be sure that you know that it's just not the metal price. It's the metal price minus the input costs. That's what a miner makes its money. It's the margins. So keep that in mind. It says a rare overweight in bonds and the two harsh conclusions attached to it. And he's talking about March 09 and December 2022. I'm not playing this. I think if we have an inflationary recession, I'm not a big fan of bonds. I'm going to go over into the energy sector. And I know that sounds weird and counterintuitive, but I think the problem is in energy. And I think it's permeating everywhere around the world. And I think recessions are going to happen because we have shortages of energy. That's my take on it. I don't think anybody can really convince me otherwise. And yes, I do think in the short term, there could be pullbacks in oil and natural gas and all these other energy prices in the short term, but I don't think they're going to be lasting. I think the underlying supply problem needs to be solved, and I don't think it is going to be solved in the next 4, 5, 6, 7 years, somewhere in that range. Here is gold in multiple currencies. They're starting to break out. So this is British pounds and Indian rupees. So we're seeing a breakout in other currencies. When you price gold in other currencies, this is against the British pound, it is starting to break higher. Same with the Indian rupee. It's starting to break higher. Gold versus the Indian rupee. Looks fantastic for a move higher. What this is one gigantic consolidation period. So gold is breaking out in other currencies. Just an FYI. It says, it's incredible how well this worked out. ARK really followed the .com era. Here's ARK coming down, and we're almost to the bottom here. As a contrarian, I know a lot of people are pretty bearish on ARK, but ARK is actually looking not too bad in probably later stages of 2023. What this is probably going to do is in the later stage of 2023, they're probably going to do some sort of stimulus. But they can't really, in my opinion, you can't do that because if you put stimulus money into the system, your total bank credit in relationship to GDP goes up, and we don't have GDP coming online because we have an energy shortage. So I think energy is going to be the thing that does incredibly well over the next couple of years. And we've got a lot of good buying opportunities in energy. The individual companies themselves, because they're, one, priced very cheap, and two, they're highly sensitive to the price of energy. But that's what I've got for today, guys. If you guys need any help in this commodity bull market, definitely sign up to the finding-value.com. The Platinum membership, use the word discount to get a discount. And there's a larger discount on the yearly membership versus the monthly membership. Again, we've got a Platinum question and answer session for the members at 5 p.m. Sunday. So I can go over any questions you guys have. And hopefully you guys like the content. Give me a thumbs up. Subscribe to the channel if you haven't. And definitely check out the website if you'd like. And you can ask me questions, guys. You can ask me questions before you sign up. Just go to the website, go to contact me or contact us, and contact me, and you can ask questions through there if you need to. All right, guys, that's all I've got. We'll catch you next time. This is Finding Value.